This is a complete guide to the crypto order book from the inside, how it actually looks, how liquidity operates, how whales track it, and how insiders read it. I work at a market making desk, so this is the view from inside the machine, not a theory about it. And along the way, we'll test the three big myths against the real thing: stop hunts, order blocks, and smart money. Quick note, this is education, not financial advice. Let's open the book.
Part 1, the order book for real.
Every market you trade is just two lists. On one side, bids, prices where people are willing to buy and how much. On the other, asks, prices where people are willing to sell. The gap between the best bid and the best ask is the spread. That's the entire machine. The chart you stare at all day is just a drawing of what already happened in these two lists. Price doesn't move because a line broke. Price moves because one of these lists ran out at that level. Once you internalize that, half the mysticism in trading evaporates. So let's put your order into the machine and watch what happens.
Part 2, what happens when you hit buy.
Say you market buy. Your order doesn't go to some counterparty in a back room. It walks the ask list, top to bottom, eating whatever is offered until it's filled. If the book is deep, you get filled near the price you saw. If the book is thin, your own order pushes the price up as it eats level after level. That gap between what you expected and what you got is slippage, and it's not a fee someone charged you. It's the shape of the book you traded into. A limit order is the opposite move. Instead of eating the list, you join it and you wait for someone else's market order to find you. Every trade ever made is just these two roles meeting.
Part 3, how liquidity operates.
Now, the part almost nobody explains. Where does all that resting depth come from? Mostly from market makers. A desk like ours quotes a bid and an ask around the current price, constantly on every venue it covers, and refreshes those quotes thousands of times a day as price moves. When you buy, you're often lifting a market maker's ask. When you sell, you're hitting their bid. The compensation is the spread, not the direction. A legitimate desk doesn't take directional bets on the tokens it quotes. And here's the property that matters most: real liquidity refills. Eat a level, and a healthy book replaces it within seconds. Depth that doesn't come back was never a market. It was decoration.
Part 4, how whales track the book.
Large players don't trade the way retail does, and the book is the reason. A whale who market buys their full size would walk the book and pay for every level of it in slippage, so they split. Big orders get sliced into hundreds of small ones, fed in over hours. They use iceberg orders. Only a slice of the real size is visible in the book, and it reloads as it fills. Before sizing anything, they check depth within 1% of price on both sides, because that number is the honest answer to what happens if I sell. And they test. A small sell into the bids tells you whether the depth is real or painted before real size ever moves. Watch a book long enough and you can see this happening. Steady one-sided flow, depth that keeps reloading at one level. That's what an actual footprint looks like.
Part 5, how insiders read it.
On a desk, nobody stares at the price. The dashboard is health metrics. The spread, tight and stable, means a healthy market. Widening means liquidity is getting nervous. Depth at 1%, both sides, all venues. What a big order would actually do. Quote, uptime. Are there live orders on every exchange, every minute? Flow imbalance. Is the aggression mostly buying or mostly selling, and is the book absorbing it? And the stress test. When the book gets hit, does depth hold and refill or evaporate? Health and direction are two different questions, and the desk only answers the first one. You can read every one of these signals yourself on any exchange for free.
Part 6, myth 1, the stop hunt.
Now you know enough to test the myths. Myth 1, market makers hunt your stop loss. Here's what actually happens. Stops cluster in predictable places. Round numbers, just under swing lows, right below support. Everyone runs the same playbook, so the same shelf fills up. When price trades into that shelf, the stops fire as market orders all at once. The book goes thin for a moment, price spikes through and snaps back when the forced selling is done. That's a liquidity sweep. Nobody needed to hunt you. The crowd built the trap by all standing in the same place. Your stop wasn't targeted. It was predictable.
Part 7, myth 2, order blocks.
Myth 2, order blocks. The theory says a big candle marks where institutions parked orders and price will return to fill them. The honest version from inside the book. That candle is a shadow of something real. A large trade did happen there, but the resting orders that caused it are gone the moment they fill. The book doesn't remember. What is real, certain price zones attract orders again and again because humans anchor to the same reference points. So the concept sometimes works, but not for the reason the theory claims. There's no institutional order sitting there waiting for you. There's a level a lot of people are watching, which is a very different thing.
Part 8, Myth 3, Smart Money.
Myth 3, smart money concepts, the idea that institutions leave footprints you can follow on a chart. Let's be fair, because you saw in part 4 that some of it is real. Large players do split orders, do work around liquidity, and do leave traces in the book. But most of what gets labeled a footprint is pattern matching on noise. Candles make shapes all day, and some will always look intentional in hindsight. The honest test is simple. Does the explanation depend on what was in the book or only on what the chart looks like? If it never touches the book, it's a story, not a mechanism.
Part 9, What Actually Moves Price.
So, what actually moves price? Imbalance. More aggressive buying than the ask side can absorb, price walks up. More selling than the bids can absorb, it walks down. When people say price seeks liquidity, that's a description, not a plan. Price keeps moving until it finds enough resting orders to stop it. Thin books move violently on small flows. Deep books barely flinch at big ones. And that's why the myths survive. Losing to a villain feels better than losing to structure. They hunted. My stop is a story with an enemy. I put my stop where everyone else did on a thin book is a mirror, but the second one is the one you can fix. Next time a chart does something violent, don't ask who did this to you. Open the book and ask what ran out. The answer is usually sitting right there in two lists in public. We're Echo Trade. We've supported more than 2,000 token launches and quote order books across 90 plus centralized exchanges every day. If you're launching a token and want your book deep, tight, and honest, the link for a free consultation is in the description. Subscribe. We break down how crypto markets really work, one piece at a time.